A very good morning to everybody. So welcome back to your live virtual classes. So I'm here today for teaching your paper one accounting foundation, and we will be going ahead with the chapter number 11. Before we get into the actual class, so I want to brief on a few particular points, right? So since this is a class that's going, like say, for the entire people all over India will be watching it, the medium of language that is chosen by me is English. So I will be going a bit slow. So you people will not find any difficulty in understanding. If in case you have any difficulty, you people can raise your hands. So we will let you ask your doubts and clarify. Okay. So when the class is going on, I think it's good of everyone to maintain few particular ethics of the class and by not disturbing the others. The chat box has been disabled because we have a lot of distractions and everything that is not happening and completely let us utilize. Okay? So the purpose for which we are here, let us utilize and make the most of this particular session. So on this particular note, I would like to start today's class. And before getting into the class, I would like to introduce myself. So I am Hayden Mine, and I've been with the BOS during the year 2020, the first batch of LPC. And it really feels good to be back and start teaching again for the LPC this time. So I'm grateful for the opportunity and I thank the viewers as usual giving this opportunity. And I am here. So if you come back to my pattern of teaching or my set of teaching, so I am here. What is the chapter that you will be handling, Madam? Can be a question. The chapter that I've chosen or that's been allotted to me is the company accounts, which is your chapter number 11. And this particular chapter has got 6 units, right? It's one of the most easiest and one of the most scoring topics that you people can have. And I am sure the people who have taken the commerce stream in your intermediate or 11th or 12th standard, already you have studied about this particular concept. But nevertheless, we will be going through in depth and we will be understanding. So my pattern of teaching will be very simple. You need to understand why you are doing a particular thing. So as of now, since we are into the fag end, I believe you have already been thorough with all your other 10 chapters and especially about how you pass a journal entry, right? So any transaction that happens, we follow double entry system of bookkeeping, which means that for every debit, you will be having a corresponding credit. So why you are supposed to debit a particular thing, why you are supposed to credit a particular thing, that comes only by practice. So I am sure that all of you would have understood the basics. That is why this chapter is coming to you at the end. Don't think it's going to be very hard or something. It's just the placement of the topics. And point number 2, how will I be teaching? What are the books that I'm going to refer? It's quite simple. It's very plain. It will be only the ICAI study material, which is applicable for your Jan 2025. So I would request all of you to kindly open, like you would have your physical books also, just kindly open and not see the books when I am teaching. Okay. So I would require your 100% concentration and 100% attention towards whatever I am teaching. If you people feel that it is being a little fast or something, there's always this option in the particular YouTube thing wherein you can go back and refer and you can check it at a lower speed also. Okay, so thanks. So now let us get back into our topic for today. So the topic for today is the company accounts. So how will you cover the unit? So I've been allotted 8 classes. So we will be taking up. So each one particular unit we take each day also, we cover the entire topic. But those which are of less importance, I would like to cover it up soon. And those which are of really big or much importance, I will be doing it in detail. I will be working out all the illustrations and I will be also working out the practical questions. So the maximum cooperation should come from your end. You should be ready to listen to the entire 2 hours so that we will complete a major portion, a major chunk of the questions. Clear? The first unit that we will be talking about under the Companies Act is just a basic introduction. So you people need to understand before you go into doing the accounting process for the company, you need to understand why there is a company or what is a company. So very simply put it across, company is formed from 2 words, comp and which words? It comes from the Latin language words, which says a company is basically an association of 2 words. What is comp? It is like coming together. What is panis? It is like over the bread. What does it got to do, madam? So what is the actual thing? So here, the main thing or the main purpose, what they were trying to convey at that time when the company was formed is A company is something that represents a business. What is a business? Any particular economic activity that we undertake. What is an economic activity? An economic activity is one which is directed towards earning profit. You will open a business or you will start a business today with the motive of earning profit or loss. Definitely nobody needs loss. So everybody is under the motive to earn a profit. So that is why they start businesses, right? So in the olden days also, a company was started, of course, on a very small scale, because today, as the needs and wants started growing, if I have a company of a smaller size, maybe the market will not be, it will not be sufficient. Consumers are more. I need to produce more. So the companies have started growing on a very, very large scale, right? So in the olden days, when you meant or when a company had to be defined, it was just discussed over. Like people used to sit together, like when they were eating, having the lunch or dinner or any get-togethers, and they used to discuss about the company matter. So that is why it was discussed or it was named like farm plans. But now company assumes a larger significance. So it is not only that you can sit and discuss at the time of eating or something, it has assumed greater importance. Because the company has, it is always quite important that the company has to be managed properly. Somebody has to take care of the company. So then came the legal act. So we have the company being covered by what act? I'm sure already you people would have studied the Companies Act came into the picture. Why, madam, should we have an act? It was all done over a particular meeting, get together. Now, what is the need? As I told you, the needs are growing, and the people now are doing companies or businesses on a very large scale. So, in order to avoid the misuse of the funds, when public is investing in a particular company, to avoid the misuse of the funds, or to ensure that the economic activity is going as per the given rules. It's quite important that it has to be governed. So we need to have law above us. We listen to the words of law because we know that we will be strictly penalized if we don't obey the rules and regulations. So then the company was identified by us passing a separate act and it got a more legal sanctity. Even before that, company is a company. But after the introduction of the Companies Act, every company that wants to be called itself as a company should get registered under the Companies Act. So that rule was passed. So we had a lot of filtrations being done and all the normal companies that's been going out in the system and companies which really wanted to do the businesses were waiting. And before going into the next details of the company, let me first discuss about what are the different forms of a business organization. My dear students, to start a business, you need not only start directly with a company. There are other options too. So people should know, if I want to start a business, what are the forms? The first and the most important, most easiest is nothing but your sole proprietorship. From the name itself, there is only one person. So it is his idea, it is his investment, he is putting it into and he is starting a business. But then for long, what happens is this after this particular sole proprietorship came into the act and the business was carried on by one single person, his money was not being sufficient. He needed help. The business started to grow. As a single person, he was not able to take care of everything. So then what happened? He started entering into the next thing, which was called as partnerships. He trusted a few people. So he thought, in my absence, let these people also take part in the business. Will they come for free? No. So they also started asking, if I am going to take care of the business, if I am going to participate in the business, I also need some return. Give me the profits, a share in the profits, what is initially to people. Slowly that started increasing. So this form of business organization was termed as the partnership. So under the partnership, you can have two or more people, and the rules and regulations were not that very strict. So the business was carried on. 2 to 3 people were sharing their resources, their knowledge, taking up the liabilities and everything. It was okay, good, comfortable. But as the time passed, what happened? The scale of the business started growing enormously to such an extent that even if 2 people or 3 people or 4 people came into the picture, the capital was not sufficient. And sometimes there were few problems between these people wherein there was no particular law that could, there was no an organized form. Because if you take for a partnership firm, technically now LLPs have come, but before that there was complete unlimited liability. Apart from the things or assets the business owns, if that is not sufficient for payment of the liabilities, personally those people will be held liable. This was not liked by many people. They felt the risk was huge. So then, since the needs changed and the times evolved, we then came into a much higher organization or much higher form of a business structure that was called as a company. So the company history is this, and how and why we wanted a company is this. So now, as I told you, the Companies Act governs each and every company. And for a company to be called as a company itself, or for a business organization to be called as a company, what should you do? Get registered under the Companies Act. The moment you get registered under the Companies Act, what happens to your company? The company gets few characteristics or it gets few features. So can we see what the features are? So the first feature a company gets or it will do under after registration is it will be called as an incorporated association. So what is the meaning of incorporated, right? So incorporated is technically very, very easy to understand. So incorporated means once you get registered under the Act, I told you the Act requires every company to be registered. The moment you register, it is like the birth of a company. So the incorporation is quite important. So only after you get incorporated, you are recognized as a company. You are being given some status in the particular the business hierarchy, and you can start communicating. You can start getting yourself identified as a separate company. So incorporated association means the company should get registered. So once it is incorporated or registered, it will be termed as an incorporated association. The second thing, the moment you get incorporated, you will get a separate legal identity, or it will be called as a separate legal entity. What is this, madam? So coming back, separate legal entity. So we are all citizens of India, right? So we have few particular rights. So likewise, a company is not a natural person because he can't breathe through anything like what we are doing. But technically, if you are getting your business organization registered under the Companies Act, you get a particular legal status in the society. So the company is technically called as an artificial person. It is called as an artificial person because it cannot be a normal or a natural person, for whatever reason. And what is the separate legal entity? By the term, a separate legal entity, we mean to say that the company has a legal status of its own, which means that it can enter into contracts, right? You and me can enter into contracts. The same way, once after the company has been incorporated, it can also enter into contract. Suppose it finds some issues in the contracts, the other person is not cooperating. There has been some violation of the rights or the duties that they have to perform. Then it can file a suit. That is the meaning. I have a legal status. Who are you to file? The other person asks, I am a company registered under the Companies Act. I can file a case. You have entered into a contract with me, and now you're not supporting the particular contract. So I will file a case against you. So, and the same way, if the company is at fault, people can file a case against the company. It can sue and it can be sued. So even if I am at mistake, sometimes even I can be at mistake. In that case, people can file case against me also. That is the most important point of this company structure, which says once after you get registered, you become an incorporated association, you take birth legally as a company, and the company status is, are you attached with your owners or something? No, I am different, the owners are different, I get a separate legal entity. In case wherein I can enter into contracts, I can sue the other person, I can be sued by the other person because I am not a natural person, but I am an artificial person. That is the legal status the Act is giving to me. Okay? And the next point or the third important point is perpetual Succession. Succession means who will take care after a particular person. So A is carrying on a business. After the demise of A, somebody should be there to take over the business. This was evident in sole proprietorship. If suppose A passes away, there is nobody to take care of the business used to collapse. Even the case with partnership, when partners were there and everything was happening, suddenly something happens to the partners, they are no longer coming, then what happens to the business? It just crumbles, it falls. Now, they established this particular essential feature that a company will have a perpetual succession, meaning that even if the members are there or even if the members are not there, irrespective of that, the company will continue to exist. How is that even possible, madam? It is the members who are actually taking care of the company. That is why the Act gives them a legal title of an artificial person. So the company technically is not dependent on the members. Members can come, members can go, but the company continues to exist. That is the meaning of perpetual succession. Okay. So then, what are the other points? The company has a common seal. What is this common seal? If I want to enter into contracts as an artificial person, what will I do? I will sign. But now, madam, you told me as an artificial, I am a natural person. As an artificial person, if the company wants to get inside a particular contract, then can a company sign, madam? Yes, it is through the common seal. Once if the contracts have the common seal of the company, then it will legally bind the company. It means that the company has consented and entered into the contract. Later, it cannot say, no, I don't want, I'm not entering into the contract. No. So common seal is one of the most important points, or it is like the signature of the company. It is a resemblance. So it is based on the company, on behalf of the company, or the company is entering into the contract through this particular medium of the common seal. Okay. And apart from this, each and every company is supposed to have a SIN number, corporate identification number. So it is all to give it a special status. It is all to identify that the particular company uniquely it exists. So you have a particular number, like all of us having an Aadhaar card, it is similar to that. Okay. So there is this common seal and the company operates through the common seal. And then the most important point, apart from all the other business organizations, the main purpose why a company was started is they wanted to have a distinction in the liability. Sole proprietor, partnership, everything was seeing unlimited liability. So what is this unlimited? First of all, what is liability? Liability is something that we have to pay. A liability is something that we are supposed to pay. Now, when I am talking about a business as a whole, okay, the meaning of unlimited liability is nothing but simple to understand. When a sole proprietor starts a business, he invests his money into the business, he carries on the business. While in the process of carrying on the business, he can acquire few assets. He can also take loans from outsiders, which are termed as liabilities. So both these will form a part of the balance sheet. Now, what happens suddenly one day, the business is not going for whatever reasons, he wants to close down the business. The moment he wants to close down the business, what happens is he will have to take a stock. Stock in the sense, how much are his assets, how much are his liabilities. Okay? Assets are 100 rupees, liabilities are 100 rupees, simple. Sell the assets, pay the liabilities, come out of the company or come out of that particular business. Now, it so happens that in some cases, assets can be only 100, but liabilities will be 200. So in that case, who is liable to pay? I myself, the company or the business, whatever, it has only 100 rupees as assets, but I am supposed to pay 200. So then what I will be doing? Then the concept of unlimited liability comes into the question. That means what? This unlimited liability means after the payment of this particular 100 rupees, the remaining shortfall of 100 rupees which I have to pay, no, personally from the personal assets of the sole proprietor or the partners, they will sell, they have to sell, and then they have to pay. What is this business I started? I wanted to know, or I wanted to do something, give people jobs, and I was very, very confident, very, very positive of going ahead with the business very in a good way, but it didn't turn out. So should I be penalized? My personal assets, everything also should be gone. So that is why opt for a company. In that case, your liability will become limited liability. What it will become? It will become limited liability. That means the capital or whatever the amount that the people or the members or the shareholders are investing in the company alone is sufficient. If they have not paid any particular portion, like for example, if a person is taking 10 shares of the company and the value of one share is 10 rupees, how much he is supposed to pay to the company? 10 shares he is taking, 10 rupees is the value, so it will be 100 rupees. But already out of 10, he has paid 7 rupees. How much he has paid? He has paid 7 rupees. That is 70 in total. How much he is supposed to pay? Only 30 because he holds 10 shares and the unpaid amount is only 3 rupees. So he will be liable only to this extent. Even if the assets or if the liability is more for the company, that's all. It is not his problem. It is not his responsibility. So in a company form of the business structure, the first thing that you get is your liability gets limited to a great extent, to the extent of the unpaid value of the shares. Why, madam, you're telling share? I will tell you. Unit 2 talks about the entire thing of shares. So when company account comes into picture, it will be shares or the different types of instruments. Clear? So what are the 5 points that we were discussing? Can we have a fast go through? So a company, to get a particular status of an actual company, you have to register yourself under the Companies Act 2013. And then once after you get registered yourself under this, the following are the features that a company will get. So from the other forms of business organization, if you want to understand that what is exactly a company, that first is an incorporated association. What is the meaning of an incorporated association? Very simple. An association or the company, once after it gets registered, it will be called as a legally registered company. So it will take birth. That is called as incorporation. So the company will be called as an incorporated or a legally given birth company. That is incorporated association. The second one is it is a separate legal entity. So like all of us, it cannot be a citizen. It is not a citizen of India, but technically it is an artificial person which is holding some particular legal status in the eyes of the society. So it will be distinct from its owners. The owners are and the company will not be one and the same. So if the company wants to sue somebody or it wants to file a case because somebody has defaulted in something, the company can go ahead. It can also enter into contracts because it has the status of a separate legal entity. And then it can also be sued. The third one is the perpetual succession. This means that irrespective of the members being there in the company or not, the company has a legal entity, it has its own identity, so it can go ahead and it can progress normally. And then the company has a common seal. So by the meaning of common seal, we mean to say that the company is identified uniquely. It is like the signature of the company. Any document bearing the signature of the company liable, it holds the company liable. It is the responsibility or duty of the company to adhere to that particular contract. So common seal, apart from that, you also have an unique SIN number or an identification number. It's corporate identification number, and then the limited liability. Unlike the other forms of business organizations, in this particular form, mainly the purpose of creating a company is, in this particular form, the liability is completely limited to the extent of unpaid value of the shares you are holding. If you are holding the particular shares and paid some amount, that's okay. The remaining portion which you have not paid only, you are supposed to pay it now. Clear? Apart from this, these are the main points of 5 things, that is incorporated association, separate legal entity, then perpetual succession, common seal, unlimited liability. And then we go back into few other not so important points, but technically what are the features of a company. So the next feature of the company is it has to maintain books of accounts. So as I was telling you, the entire purpose of you studying your accounts in 3 levels of intermediate, foundation, and final is the only purpose that tomorrow when you all become chartered accountants, you will know what are the rules that are applicable for maintenance of the books. What are these books? So like we have studied, every business organization has to record the transactions because they'll forget. So for that, we use accounting as a medium. We use accounting as a language and we convert the transactions and we play with numbers and to finally identify whether the business I have started is giving me good returns or not. So for that, we prepare different set of books. All of them have to be prepared even in the case of a company. Clear? That is why we had chapter 7, chapter 8, chapter 9, which was all talking about preparation of the books of accounts. Different forms of organizations though. One is for sole proprietor, one is for incomplete records, other was for NPO. Technically, the same thing will be followed, but the rules will be defined. So there will be a set of rules for preparing the books of accounts given under your Companies Act. So every company that is registered is supposed to maintain all the books of accounts, any papers, the financial statements as prescribed by the Companies Act. Clear? Now, madam, I have prepared all the books of accounts. Who will see this? The business owners, okay, they get the summary that is enough, but so many books in detail, why should I even prepare? The next thing is the books of accounts will be prepared and there will also be an audit that is being conducted. Because finally, ultimately, we need to understand that whether whatever is happening in the business is correct or not, whether the business is following the rules and regulations or not. In case of a public company, public money is involved here. What is happening? I should see properly, correctly, whatever the books of accounts are maintained should be audited. What is the meaning of audit? Checked. Checked by who? Chartered accountants. In few cases, other professionals. Audit will be done, and then what happens? We come to an assertion that this particular business has maintained books of accounts as per required by the law, and all of the books and accounts are giving a true and a fair view of whatever affairs are happening inside. So I am certifying. I am telling them, yes, whatever is happening is correct. So one of the most important features, apart from having all the 5 other things, is you are supposed to, if you are a company, you are supposed to maintain certain books of accounts which are defined to you under the Companies Act. And those books of accounts will be audited separately. And all of this information should be given access to the public because their money is involved. When I am talking about access to the public money is involved, I am talking about a public company exclusively. Okay, that means what, madam? There can be different types of companies. Yes, there can be different types of companies. Before we go into the different types of companies, since we are talking about the maintenance of books of accounts, so you can ask me, what are the books of accounts that I have to maintain? Okay, so now I will be erasing this particular part so that we can start using this. I know it will be a little different for all of you because still now we are used to the software and the other faculties. But trust me, writing on the board and listening, it is actually, it has a very good impact as well. Not saying it doesn't, it definitely has. Okay. So then coming back, what are the books of accounts that I am supposed to maintain? Maintained by a company. Okay. So I told you the books of accounts for these particular rules are defined in the Companies Act. So you can ask me which sections, madam. Are we supposed to remember the sections also? Technically not needed, but since I am teaching you, section 128 and 129 of the Companies Act states that every company, okay, every company shall maintain all books of accounts, or it can be any papers related to the business, or you can have the financial statements at it's a registered office. What is this registered office? When you get yourself incorporated, right? You will say my main place of business. So it acts like your head office. So my main place of business is in this registered office. Plus, if you are having any branches, so in all the branches, all this particular books of accounts, papers, and financial statements should be made available. It shall be made available, okay, in the registered office and branches. And what should these particular books of accounts tell you? It shall give you true and fair view of the transactions. So whatever has happened in the business, it should represent a true and fair view. So that is given under section 128. Now, madam, you're telling books of account, papers, financial statements. So can you elaborate on this? Yes. What does the financial statements of a company tell me, or what is it given? So your Schedule 3 of the Companies Act exclusively talks about what is the financial statements required for a company. Okay. So in that you have part 1 and part 2. In the part 1, it is the balance sheet. So what is a balance sheet? Balance sheet is called as the position statement. And it is a statement from which at any given point in time, I can see what are the assets, what are the liabilities, and how much is the capital of any particular business, right? So this is the very layman understanding that we have done. But if you go to the presentation of balance sheet under the Schedule 3 Part 1, it will be a very different format. It will be a vertical presentation. So you don't no longer have assets on the right side, liabilities on the left side. No. It works as a single vertical format wherein first we start with the liability side. Under that, we have non-current and current. So there is a distinction. Instead of calling each and everything like sundry debtors, sundry creditors, and then bills payable, and then capital, loans taken. No. All the liabilities are very clean deep, and then it is being divided into you have equities, and then you have non-current, and then you have current liabilities. Current is something which will be there for a period of less than 12 months. Non-current is for a period of more than 12 months. 12 months is 1 year that we are following, right? Same way for the assets also. So under the assets, we have non-current assets and then current assets. So it is the same. Whatever you have done in a particular manner till now in foundation is one part of the game. And the other part of the game is when you start actually preparing the balance sheets and P&L accounts as per the particular part 1 and part 2, form 1 or form 2. Okay. So then the part 2, you will get your profit and loss account. Now the question will be, madam, should I remember the formats? Should I do the same thing in the exam? My dear students, at the foundation level, no. Okay. In few of the questions in the company accounts itself, in few of the units, we will be seeing how an extract will work. Okay. But never in the other chapters this will be used because we are not talking about company accounts. Exclusively for company accounts, you will not be getting a full-length problem. It will be only always talking about the shares part of it. So we will be forming or we will be writing and we will be trying to understand how does an extract of a balance sheet looks like only for a certain portion. But you people have to remember for a company, it is a Schedule 3 of the Companies Act which comes into the picture. And as per that, you have part 1, part 2, which gives you the formats for balance sheet and P&L. So every company has to prepare balance sheet, every company has to prepare P&L account, and every company has to give the cash flow statements. What is this cash flow statements? It is nothing but what is the movement of the cash in the business. My company can be very high on profits, but it is still low on cash. How is that possible, madam? My sales can be more, no? But all the sales can be credit sales also. There are possibilities. So in order to understand whether a business is doing okay and the cash is inflow, outflow, everything is matching or not, it's important that we prepare the cash flow statement. And then we prepare the statement called as statement of changes in equity. What it is called? Statement of changes in equity if needed. And finally, you have the explanatory notes. Obviously, no. We used to have notes to accounts even before, now also we have. So these are the things that I have to prepare as a part of my books of accounts for a company. Clear? So now we are going to very quickly go through what are the different types of company. Is this clear to everybody? So every company registered under the Companies Act, as per the section 128, is supposed to maintain books of accounts, papers, and financial statements, both. Like now everything has changed into the electronic format. Nobody still sits and writes. So they are supposed to maintain them in the electronic format and the registered office and the other places like its branches, which should give a true and a fair view. So when the books are being prepared like this, we have the external auditors, or they can also have internal auditors who will come and check this particular books. So section 129 talks about what does the financial statements tell us, or what forms a part of the financial statements. Very simple. They are balance sheet, profit and loss account, a cash flow statement, changes in the equity, that particular statement, and explanatory notes. Why you have done, what you have done, what is the explanation, it will all form part of an explanatory notes. So when you go for a listed company or a public listed company, you will get their information printed in sort of books. So when you get those books, try to understand how the balance sheets are made. It will be as per the schedule 3. It's out of the interest, and when you read your explanatory notes, maximum information will be covered here. So my dear students, here there is another point that, madam, for all the companies will this come into the picture. There are 3 particular companies which are governed separately by different acts. One is the banking company, the other one is the insurance company, and the other companies are the power companies which are engaged in the generation and distribution of electricity. Generation and distribution of electricity. So for these 3, why, madam, I'm not preparing it in the same format. Still these companies will prepare. So don't think that the companies will not at all prepare. No, they will prepare. But the format or which is the act that is governing these 3 is different. Okay? So you have an insurance act, you have a banking act, and you have a power generation. There is a separate act related to that. So based on those acts, these particular companies will follow a different formatting and presentation rules because the particular law tells like that. Apart from them, all the other companies registered under the Companies Act are supposed to follow these particular rules. Here, so that is with regard to the maintenance of the books. Now we are going to check the different types of companies. So what and all can be the company? So the first type, or the simple and the foremost type that all of you know, is a public company and a private company, right? A public company is one which is not a private company, that's the definition. But technically understanding, a public company is one which collects money or invites the public to contribute to its capital, right? So first let us talk about a public company, because that's what we are seeing. The major types of companies are public company, private company. Both are opposite. In a public company, the public is invited to contribute to the capital. That is the basic understanding. Contribute to the capital of the particular company. And apart from this, it also has few other features which will be distinguishing it from a private company. So the first thing is, the public is invited to contribute the capital. And for a public company to be established, or for your company to get the public company status, your minimum paid up capital. What is this, madam? I will explain it in detail when we start the unit 2. For now, remember, minimum paid up capital will be 5 lakhs. So if you want to incorporate a public company, your paid up capital should be 5 lakhs. Only after that you can start. What is a private company? Public is not invited. I cannot keep inviting everybody. No. Very private to my particular people only. I am going to get the capital from them. And I will not let them transfer my shares also. I will restrict the transfer of shares. And here the minimum paid up capital is lesser than a public company. It comes to 1 lakh. And my maximum number of members. So how many members can be there, madam? Maximum 200 members can be there for a private company. Minimum with 2 people I can start. But there is a company wherein it will be called as a company with only 1 member. That is called as an OPC, 1-person company. You also have that particular company, 1-person company. That is one type of a company. And then next we have apart from these companies, we have a government company. So the definition of a government company, all of you know what it is, where 51% of the paid up capital is held by either the central government or the state government, or partly by central and the state government. So this is the definition of a government company here. So it can be 51% held by a central government or state government, partly by central or partly by state. Then we have a foreign company. What is a foreign company? Which means that a foreign company is a company which has its registered office outside India. That means it is not registered under the Act in India. That is not the meaning. The registered office or the principal place of business, the main activity is outside India, and the other activities, or there is a place of business in India. That is why we are concerned about this company. We are studying it under one of the classifications of the company, right? So here the registered office outside India, but there is a place of business in India. And then you have listed company and unlisted company. The particular companies and the shares that you're seeing on your NSE, BSE, the recognized stock exchanges are nothing but they are called as listed companies. Okay. Now, an unlisted company means it has not been recognized by any stock exchange. That means the shares are not available for trading by the public. They are unlisted companies. So they can be either a public company or a private company. They can be a public company or a private company, right? And then the next one will be limited company and unlimited company also. So like in the case where we have seen that your liability can be limited or the liability can be unlimited, here also the company will have the particular segregation. And finally, you have holding company and subsidiary company. Holding company and subsidiary company. What is a holding company? So holding company has the upper hand. When a company holds 51% of the paid up capital of another company, then automatically the other company becomes its subsidiary. It has to listen to whatever the holding company is doing. So it is like the parent company. So that is holding company and subsidiary company. So to discuss again and to have a very fast recap, the types of companies that we are seeing is, first you have a public company. Public company is one which invites the shares from the public. That means public can come and invest in the shares of this particular company. And the minimum paid up capital should be 5 lakhs for a company to be registered, or that is one of the criteria for a public company. And a private company is one which is not open for the public people to invest. Private people only will come into the picture, and even then transferring, there is a restriction for you to transfer the shares from one person to another. And here the minimum paid up capital is lesser than a public company, which is 1 lakh rupees, and maximum number of members comes to 200, right? And I told you there can also be one person company, an OPC, wherein there is one person who takes care entirely. He is the member, one person member. Then a government company is one wherein 51% of the paid up capital is held by central government, state government, or combination of center and state. A foreign company is a company which has its registered or principal place of business outside India, but one of the branches or one of the line of business is also there in India. That is why we are studying about foreign companies. A public or a private company can either be listed or unlisted. What is the meaning of listed? When the shares of the company is listed on a stock exchange, then it is called as a listed company. If it is not, then it is an unlisted company. And then you have the holding and subsidiary. A holding company is one which controls, like it can have 51% of the paid up capital entirely, or the board of directors of the subsidiary company can be controlled by the holding company. So holding and subsidiary are like parent and child. The holding company is the parent and the subsidiary company is like the child. So this is it with regard to your unit 1 of your particular company accounts, wherein we have seen the complete structure of how a company looks, what is a company, what was the history of a company, how it was derived, the name, and then now how the company is functioning, how the company has evolved, what are the legal requirements, and what are the technical terms. So if I say a company is there, immediately you people should think, okay, incorporated association, separate legal entity, perpetual succession, there is a common seal, there is a limited liability. It has to maintain books of accounts, and the books of accounts will be audited by auditors. And then it is also open, like with a public company, those books of accounts will also be open for inspection by the public. All these should flash into your thing. Then when you talk about what are books of accounts, then Schedule 3 of the Companies Act 2013 should come into your mind. Schedule 3 prescribes the forms for balance sheet under Part 1 and Part 2 of your is for your P&L account, that's your profit and loss. Apart from that, I should also prepare my cash flow statements and then changes in equity, that statement I have to prepare, and for everything, what I have done, why I have taken, all the assumptions and everything, explanatory notes should be given. Clear? And then what are the types of the companies is what we have seen here. Now, my dear students, we will be moving ahead with our unit number 2, which talks exclusively about how can you, what are shares, how can you issue them. So what are the accounting treatments? Being or studying the paper on accounting, we are always concerned about from the angle of accounting. How are we going to show this? How are we going to account it? Why are we supposed to do this? Okay. So basically the unit 2 talks about the issue of shares, okay, forfeiture of the shares and reissue of the shares. So there are 3 concepts, but my dear students, when you're talking about issue of shares, there itself we will find so many internal small topics and small concepts coming there, okay. But the major broad classification is first issue of shares, and so we are proceeding to unit number 2. Issue of shares, and then we have forfeiture and reissue. Right? Completely we'll talk about the issue of shares, and based on the time permission, like forfeiture and the reissue, if we are able to cover it today, we will, but otherwise we will do it in the next session. Right? Now we are talking about things. The first thing we need to understand, what is a share? So the English meaning or the English understanding is share is nothing but you also have a right. You also have a right in something. 2 people are there. Both of them are sisters or both of them brothers. So let us say they will have a share in the property. They will have equal share in the property. Right? So the share means something you have a right in a particular subject matter. So now when I'm talking about this share in the context of a company, I told you that one of the major point of having a company form of business organization is I will get more money. That means the amount I need for doing the business, right? What is it called in the technical terms? It is called as capital. So the capital or the money the business requires in the form of a company, or in case of a business organization, the capital will be more. I can get more money. So from whom are you getting this more money? We are talking about a public company. Whom are you getting this more money? You are inviting the public to subscribe. So you will be getting introduced to new words. The first thing is subscribe, public to subscribe. What is the meaning? Suppose the company needs 1 lakh rupees. The company needs, what is the capital that is needed? It is 1 lakh rupees. So the company needs 1 lakh rupees as the capital. And what it will do? Will it give it to one person? No. For the ease, for it to get money instantly, it will divide this 1 lakh. How will I divide? What is the medium for me to divide? That is when it will say, I will issue few instruments. What is the meaning of this instruments thing? So one of the things that I can issue are the shares. The other instrument that I can issue are called as the debentures. Now we will read about the shares. So what is the meaning, madam? It is simple. The entire money is not taken from a single person, but rather it is broken down into the form of shares. That means a person who is holding a share is nothing but he is holding a share in the entire capital. The meaning is, for example, the 1 lakh can be divided like this. I can say I am having 10,000 shares. Into the value of each share will be 10 rupees. So when I multiply 10,000 into 10, am I getting 1 lakh? Yes. What is the purpose? Why you should divide? Because I don't want this 1 lakh from a single person. To avoid that part, I am getting it from 10,000. Maybe one person, if each one person takes one share also, it will be 10,000 people who become the shareholders of the company. And each person is having a stake of how much? 10 rupees in the company. So if he gives his 10 rupees over, his liability is over. Like that, it will be divided. So when I am talking about the share capital, so why did we start this? When we are talking about share capital, it means the money raised by the issue of shares. So a company comes forward and it says, I need 1 lakh rupees, and this 1 lakh rupees, I am dividing it into 10,000 shares of 10x. This is an example. It can be into any denominations. 10,000 shares into 10 rupees. And I am now inviting you people. How much ever you people are able to invest in my company, please give me the money. So that is how generally a company issues the shares. So this is the basic understanding. So share capital means it is the money that is required by the company, which is raised through the issue of the shares. So madam, you can tell me, then there will be something called as debenture capital also. Yes, when the money is raised by the issue of debenture, that will be called as debenture capital. Clear? So now we are talking about the entire part of the shares. Now under the share capital, now comes the position. Now we will be talking about what are the types of share capital. Very quickly, very easily, quite easy. Types of share capital. Can there be types of share capital also? Yes. The first thing called as the authorized capital. Authorized from something means your authority, or you can say the supreme thing. So you can ask me, madam, if a company is going for issuing of shares or something, where will I get to know the information? Every company which is proposing to go for the issue of shares is supposed to file a particular document called as the prospectus. This prospectus gives the details of the shares about the company first, and what are the shares that the company is wanting to invest, and what is the value, and every other detail that is related to the issue of the shares by the company is covered completely under your prospectus. Clear? So I will come to know from this. Now, before the prospectus, the company, when it is formed, you need to have something called as MOA and AOA. So Memorandum of Association and Articles of Association. They are like the base documents. Everything that the company does should be defined here. The memorandum will hold few clauses. So under one of the clause called as the capital clause, they will mention the maximum amount of capital that is needed by the company. So at any point in time, the maximum capital that is needed by the company will always be defined in your capital clause, and this capital is called as the authorized capital. Suppose I am defining in my capital clause that the company will need 10 lakh rupees as the total capital in its lifetime, then that will be called as the authorized capital. Can you raise a rupee more than the 10 lakhs? Technically, no. That is why you have the maximum fixed through these particular authorized capital. You have the maximum fixed through the authorized capital. Is this clear to everybody? The authorized capital is one which involves or which depicts or which is forming a part of the capital clause given in the Memorandum of Association. And in the simple words, it is nothing but the maximum amount of capital that a company can raise by the issue of shares. So here I have given you an example. 10 lakh rupees is the maximum capital. And in that they themselves will tell you, we are breaking down the shares into suppose say 10,000 shares of 100 each. This is how your particular authorized capital will look. So totally the company can take 10,000 shares of 100 rupees each because the maximum capital is this much. That is your 10 lakhs authorized capital. Now let us go into the next one, which is the issued capital. Now sometimes, my dear students, what happens? The entire 10,000, like 10 lakhs, whatever is needed by the company cannot be required immediately. Like they can tell that out of 10 lakhs, if I get 5 lakhs now, I will carry on the business. In the future, whenever I need money, then I will issue those shares and get it. That is, the company can decide like this. So in such cases, wherein the company decides to issue a part of the authorized shares, then that will be called as the issued capital. So out of 10,000, I am issuing 5,000 shares to the public for them to come and invest in my company. So the amount of shares that I am issuing to the public will be called as the issued capital. And in my case, the authorized capital completely I am not issuing. I am holding a portion. But in some cases, you can issue also. There is no hard and fast rule that always authorized only part of it you should do. No. Anytime you can issue. But technically, few of the companies follow this method wherein authorized portion, they don't call entirely the shares. They don't issue it entirely. But they issue only part of the shares also they can issue. But what is the understanding of issued capital? Out of the authorized capital, how many shares you are issuing to the public for consideration, issuing to the public for asking them to subscribe in your capital, that is called as issued capital. And after the issue, you will be having something called as the subscribed. Issued company is doing to the public. Subscribe, the public reply backs to the company. That means what? I have given 5,000 shares. Out of 5,000 shares, people have accepted. People have given me money for 5,000 shares into 100. So the company has received 5 lakhs. The meaning is this particular part of the capital, out of which whatever is being issued, if it is taken up by the public, so those portion of the shares which is taken up by the public is called as your subscribed capital. Authorized capital, issued capital, and subscribed capital. Okay? Authorized, issued, subscribed. So till now we were talking about only a part or nothing but shares. Total number of shares, how much I can have maximum is told by the authorized capital. Out of the authorized capital, how much you are issuing to the public becomes your issued capital. And the last part comes, or the next part is nothing but how much the people out of the issued capital by the company, how much the people are taking up. That is called as the subscribed capital. And apart from this, you have two other things also. So they are nothing but called up capital and paid up capital. Called up capital and paid up capital. What is the meaning, madam? So till now we were talking about the shares. 10,000 shares total, 5,000 shares I've issued, and 5,000 shares people have subscribed. Now when I talk about called up, paid up, it is about the value of the share. So now we are starting to understand an important concept. I told you in the authorized or in the prospectus, we will mention the number of shares and the value per share. This value per share is called as the face value or par value or the nominal value. What is the important or what is the meaning of this? It is nothing but when you are breaking down your authorized capital, it is always important for a company to mention what is the face value. So here in my example, I have taken 100 rupees as the face value. So whenever a company goes for listing and it is dealing with public money, the important person or an important regulator who comes into the picture is the SEBI, Securities Exchange Board of India. So these people, they come into the picture and they give few particular regulations and rules to be followed. You are supposed to follow them. One such rule, the most important rule is any company who is going for the shares has to not issue the entire face value at one lot. That means even if people have taken 5,000 shares, they have subscribed, you cannot collect 100 rupees one time itself. No, 100 rupees should be broken down into installments. Minimum 2 installments should be there. Maximum you can have any number of installments. Okay. But generally, the questions that we will be seeing for solving here usually have maximum 3 or in few rare cases 4. So you can have 4 installments, and they have also given the name for those installments. The first one is called as the application installment. The second one is called as the allotment installment. Then you have calls. The calls can be first call, and then you can have second call, or you can have final call. So the names will differ for calls, but constantly application and allotment will be the words that is being used. So what did SEBI now say to me? SEBI has told me, don't collect 100 rupees at one shot. No. Investors should be given some time. So break the face value into installments. How many installments? Maximum, the things that we will see in the questions are 4. But a minimum 2 installments should be there, right? No, otherwise there is no point. I can take 100 rupees in one lot itself. So I will be having these 2 installments, and after that, first call, second call is my prerogative. I can have it or not required also. Clear? So this is the first rule that you will learn. Even in this first rule, there is one particular thing. It says the application installment is there. No, the first installment, as per the SEBI rules, it says should not be less than 25% of the issue price. Madam, now only you told me face value, nominal value, par value. Now, what is this issue price again? My dear students, the face value is the value that is given to you on the face of the share certificate, which means that whenever you are purchasing the shares of a company, you will get to see what is the face value separately. But always not required that the face value should be equal to the issue value. A company like any big companies that you take today, when you see their share trading in a particular market, the issue prices will be like very, very huge, but the face value will still be 10. It will be trading at 4,000 rupees, let us say. So the 3,990 rupees is for the goodwill of the company. So since the company has been giving so much returns and the public's trust is really more, they are ready to invest even at 4,000 rupees for a 10 rupees face value company. Okay. So that is why they say issue price becomes very, very important. Right? Issue price becomes very, very important because the amount that you have to fix here should not be less than 25% of it. For example, if we consider 100 rupees is the issue price, your application money should be minimum 25. You cannot have 5 rupees there. Okay? That means application money should always be 25%. Why? No, why this rule is being passed, The company at the first instant, it needs to get some good money. So whatever it is issuing, of that 25%, if it gets, then it will be able to do the business and it will be able to protect the money invested by the public. So that is the understanding, and that is why 25% of the issue price is kept as a norm. Is this clear to everybody? So now coming back, when this is broken into installments, the company asks for money. So it says, my dear shareholders, you have taken 5,000 shares. Now it is the time for my allotment. So allotment, suppose I say this particular breakup, I have application 25, allotment 25, first call 25, second call 25. So now it is the time for allotment. Please give me the allotment money. So I am doing 5,000 shares you have taken. Now give me the allotment money. So when it is calling for the money, this will be called as the called up capital. So when the company is requesting for the money from the shareholders, that will be called as the called up capital. And when you are making calls, obviously who has to pay? Shareholders have to pay the money. So when the shareholders pay the money, it will be termed as paid up capital. Suppose, let us think, out of the 5,000 shares that you asked money for, 100 shares or a shareholder who is holding 100 shares of the company does not pay the money. He does not have money, so he does not pay the money. Then what will happen? It is like a loss to the company. So you will take it to separate account called as calls in arrears. Clear? So this concept anyways, which we are going to see in depth in our further class proceedings. But now technically called up capital is one the company calls from the public. Paid up capital is one the public pays to the company. And when they are paying, sometimes there can be a default. Some shareholders cannot or might not pay. I'm not saying they will not pay, they will pay. Sometimes in circumstances, it happens that few shareholders are not able to pay. In that case, you will have to record it as a loss for the company because the amount that they wanted was not there, right? So that will come here. It will come under a separate account called as calls in arrears. The opposite of calls in arrears is calls in advance also. So calls in advance also can be there, which I will be taking a little later. So now coming back, the share capital of the company is broken down into 5 different types of capital. The first one and the topmost one being the authorized capital. Authorized capital is nothing but as defined by the company. It is the maximum shares or maximum capital a company can raise by the issue of shares, which is being defined in the capital clause as defined or as written in your memorandum of association. So generally you will file the memorandum of association with the registrar of companies. So you give a clear message telling that the total value I cannot raise 1 rupee even more than the 10 lakhs. So that will be divided. So the breakup of the capital, like how many shares, what is the value of shares, everything should be given here itself. That is my authorized. Out of the entire authorized share capital, I can issue the entire capital or the entire shares, or I can hold a portion and only issue the remaining portion. Out of the authorized capital, the number of shares that you are issuing to the public will be called as your issued capital. And when you issue capital to the public, the people will reply back like investing in a company, purchasing the shares of the company. It's called as subscribing for the shares. So that part of your capital will be called as the subscribed capital. Now, these are all talking about the shares. When you talk about the value, so on the face of the particular share certificate, what is the value of a share that is written is called as face value, par value, or the nominal value. So usually this will not be collected in one installment. A minimum of 2 installments should be maintained. Who has told this? SEBI has come into the picture because this is a regulatory organization for all the companies that's getting listed because they involve the public money. For the interest of the public, they come and they give you the first thing that they are telling is don't collect the entire face value in one lot. Break it into installments. Minimum 2 installments, maximum you can have anything. They have given names for that also. The first one is called application. The second one is called allotment. There's a logical explanation also. Once when you are coming to the first thing, I mean like first step when the company is asking you people to invest in the company, you will apply for it, correct? For getting membership or for getting a seat in any particular college, first thing is you should apply for that, no? So for you to become a shareholder in the company also, you are supposed to apply for the shares in the company, right? So you will be applying that money, what you pay on the number of shares into application money is the first installment. After you apply, the company will come to know, okay, these are the people who have applied and I'm allotting the shares to them. So you become the shareholders only after the receipt of the application money. And apart after receiving the application money, the second step or the second installment is allotment. And then you can have any number of calls. So whatever the company is calling from the public, it is called as called up capital. And out of the called up capital, paid up capital. What is a paid up capital? When the shareholders are paying back that particular call money, it will be called as the paid up capital. But in some cases, few shareholders might default. That is called or taken to a separate account called as calls in arrears. Is this clear? And then the last type of capital is called as the reserve capital. So like in a bike for the petrol, we had reserve, or now also we are having the reserve. So it comes to an end. So it keeps you, it's like a trigger. It's like a warning. The same way, the reserve capital is that portion of the issued capital. So you're issuing it, but you're not yet called up. Uncalled capital. So what is the meaning or what is the thing of the reserve capital is nothing but it is issued uncalled capital. Then what is the purpose, madam? When will I call it? So the technical purpose is when at the time of closing down the company, I will need some money. No, I was talking about limited liability where I told 3 rupees is the limited liability of the shareholder. The same thing here when you are talking about reserve capital, it means the capital which is held in reserve. When will it be used? It will be used only at the time of winding up of the company and not any time during the lifetime. So that reserve capital will always be there and people will come to contribute at a later point. Where will you show this in your balance sheet? Nowhere I will be showing it in the balance sheet. The reserve capital will not come in the balance sheet. But there is another account which is called as the capital reserve. What is that? Capital reserve. Very important. So always, or there can be your MCQs can test you on this portion. Reserve capital and capital reserve, are they one and the same? No. Reserve capital is a part of the capital, share capital, which is not called, except while the closure or winding up of the company only, this capital will be called. Okay, that is one. Point number two, when you come to the capital reserve, it is a reserve created out of the profits. That too, which profits? Capital profits. That means if there are any capital assets being sold and you make a profit on them, then it will be classified or taken to a separate reserve called as the capital reserve. Will this come in the balance sheet? Yes, it will come in the balance sheet under the head the reserves and surplus. It will be coming into the balance sheet under the head reserves and surplus. Okay, so this and this are different. Reserve capital is different. Capital reserve is different. So that part you need to understand. Now, after speaking about the particular type of the capitals that is there, the second, before we go into the accounting of shares, one small topic as to the types of shares that we have. Okay, there can be two types of shares. One is your preference share. The other will be your equity shares. So, madam, okay, now you told me share capital and everything. So, now we come to the types of shares. So, shares can be of different types. You can have preference shares or you can have the equity shares, right? Preference shares and equity shares. So, the point here is, what is a preference share? What is an equity share? A preference share, as the name suggests, it has a preference over whom? Over the equity people or the people or the shareholders holding equity shares. More than them, these people get a preference. That means what? In what and what they are getting preference, madam? In the payment of dividend. Now we come to the concept of what is a dividend. Dividend is nothing but the people are investing money into the business, right? And the profits that the company is making, some portion of it, you are supposed to return it back. So companies have policies to give a portion of the profits back to the shareholders, because ultimately it's the money of the shareholders that I have used. So that return which the company is giving, right, it will be termed as dividends for shares. Okay. For debentures, it is termed as interest, because you know, right, if you are taking a loan from the bank, you are supposed to pay the bank interest. Like that, for the money, wherever you are getting it or you are investing, everybody will expect a return. And the return that is paid to the shareholders, be it a preference shareholder or equity shareholder, the word is called as dividend. So when the company makes the profit, first it is paid to the preference. After giving for all the expenses and everything, the net profit will be there now. In that, the first charge or the first preference is given to whom? Preference shareholders. Same way, at the time of winding up or closure of the company, when we have to give back the capital. So when you are repaying the capital, what happens? Who is given the first preference? Preference share capital or preference shareholders are given the first preference. The amount that is invested by the preference shareholders is first repaid to them. And if anything is left only, the equity shareholders are paid. Then you can ask me a simple question, then why should I take equity shares itself? I am getting so much preference in preference shareholders, preference shares, right? But my dear students, equity shareholders are called as the residual owners. They are called as the residual owners. By owners, I mean they have the voting rights in all the important decisions of the business. That is not there for a preference shareholder. That is the difference. So the main difference is equity shareholders are like the owners of the company, but residual owners, because after everybody are paid, after the preference shareholders are paid, only they get anything if it is left out. Sometimes after payment to the preference shareholders, nothing can be left. So they will not get anything only, but they are treated as owners. So few of them have that contentment. So I am the owner of the company, so that is enough for me. I need not get anything also. So those kind of people will invest in the equity shares. Okay. Now, under the preference shares, you have 4 different types of preference shares. It is just for your theory purpose that you have to know. Issue of preference shares is the next unit wherein we will do it completely in that particular unit. And this unit, we are going to talk completely about the equity shares. How are we going to issue? What are the different cases of issue? What and all you can encounter? And then what is the core feature? What is the reissue part of equity shares we will do in this unit? And mostly, majorly, the equity part, this unit 2 carries a lot of weightage. So please give proper your attention here. So coming back to the types of preference shares, first thing you have cumulative preference shares and non-cumulative preference shares. What is the meaning of cumulative? Cumulative, cumulate to accumulate. When in 1 year, the dividend is not being paid. So my dear students, you people need to understand this. Dividend is an appropriation of profit. What is the meaning of appropriation? That means only when there is profit, the company will want to pay the dividend. If there is no profit, no dividend. Okay, with that condition only these people will enter or purchase the preference shares or equity shares. Clear? So when you are given a cumulative preference share, the word cumulate says, if I am not paid dividend this year, carry it forward to the next year and then pay the dividend in arrears. So in whichever year the company is earning the profit, till that time I will accumulate whatever is pending for me for many years it can be, or for 1 year it can be. I am going to get my dividend at the end. Non-cumulative, if for that year you are not having profits, the company is not making any profits, over here. You are not getting your dividend, that's it. You cannot ask at a later point in time. So usually the companies will give only non-cumulative preference shares because there is a risk in cumulative. If you issue cumulative and the dividend is not paid for more than 2 years, then the preference shareholders get the voting rights. So why to have this headache? Let us not have the headache. Let us not do it at all. So companies generally give non-cumulative preference shares. This is the meaning of cumulative, non-cumulative. Next, you have participating preference shares and non-participating preference shares. What is the meaning of participate to? You get yourself involved in something. I told you, first when the company makes the profits, after giving for all the expenses, first who will be paid? Preference shareholders. Then who will be paid? Equity shareholders. After that also, if the company has profits, these people will again come into the picture. I want to participate. Give me. So, if there is any profit that is remaining with the company after the payment of the equity shareholders, if you have issued a participating preference share, then those shareholders will again ask for a share in that particular remaining profit. Okay? Non-participating, no, your due is over. No, that's all. Even if the company has extra, it will take for its own growth and expansion in the future. Why are we supposed to pay? Generally, the companies issue non-participating preference shares. Okay, the third type is redeemable and irredeemable or non-redeemable. What is redeemable? The simple understanding English is redeemable is nothing but repay. When I am issuing the preference shares at the time of issue itself, I will tell them after a certain period, I will repay it back. So when the preference shares are issued with the time of repayment, they are called as redeemable preference shares. Irredeemable or non-redeemable? They are not repaid. What? Not repaid. Yes. During the lifetime of the business, you are not going to repay them. Okay? But the maximum life period of an irredeemable share is 20 years. If you are into infrastructure projects company, then you can issue an irredeemable preference shares for more than 20 years till the lifetime of the business. But usually the lifetime of the business or for the irredeemable preference shares is taken as 20 years. Here redeemable, you know, it can be 5 years, 3 years, 2 years, 10 years, anything. Okay. Now that is this. And the final part of the preference shares are convertible and non-convertible preference shares. Okay. So what is convertible? From the name itself, you know that it can be converted from one form into another form. So you tell me whether a preference shareholder while getting converted would like to get which share of the company? Obviously equity shares. So when you want to convert on this convertible preference shares, if they are issued by the company, it means that the company gives a right to the preference shareholder that after a certain period in time, you can get converted yourself into the equity shareholders. You can become the equity shareholders. But non-convertible, no, you will stay only as the preference shareholders. You cannot convert yourself. So usually what the company will, or what usually the companies issue is, they issue a non-cumulative, non-participating, redeemable, and non-convertible preference shares. So the company's interest also matters, right? So they will not take any chance, and usually they will do this. But sometimes the company, to get the money that it wants also, it can opt for any other combination also. Okay, right? So this is the preference shares that you have to know. So now we go back after discussing a lot of points into the issue of shares. Now the shares can be issued for cash or consideration other than cash. So you need to first understand what is what. Technically, a company needs money. It needs capital. That is why I told you, you are going to issue the instruments, either of the instrument shares or debentures. Now we are talking about shares. Then, madam, if I don't get money, what is the need for me to issue shares? No. Sometimes you can issue shares for consideration. So when I'm talking of issue of shares, it can be issued for cash, which is the normal one that we all know. It can also be issued for consideration other than cash. What is this consideration other than cash, madam? For a simple example, we will be doing it at the end. But now to understand, the simple example is, you have purchased an asset or a machinery which is worth so much money from a particular vendor. So now what do? Is you need the machinery, but you don't have that much cash. So what can you do? So immediately you can make an offer to the vendor stating, right now I don't have full cash, but you become my equity shareholder so that you get the voting rights. You will also get the dividend, and you will also get a share in the company for the same value that you have given to me. Okay. So here the worth of the machinery, he is not directly giving you cash, but instead of cash, he is giving you a consideration. He is giving you what? He is giving his machinery to you. So in such cases, for the consideration other than cash given by a person to you, he can be issued the shares. Is it clear? He can be issued the shares. So consideration need not always be in cash. I issue shares for any asset or any benefit that you are giving to me. If I consider that benefit is very important, I can make you a part of the company also. Clear? So that is consideration other than cash. Now we get back into the accounting entry. Very, very important accounting entry for issue of shares for cash. So obviously when I'm telling cash, they don't give you in real cash. It will all be bank transactions. Is that clear? So you tell me, my dear students, when you are receiving money by issuing shares, what will be the journal entry? So we go back to the basics. When anything comes inside, debit what comes inside, or the other way of understanding as per the accounting equation is, when the bank balance increases, you are supposed to, what you should do? Debit the bank. So generally, one entry which says bank account debit to equity share capital, right? I'm getting money from what? Share capital. I'm raising or issuing shares. So I am doing this. Finish. Money raised by issue of shares. This is one entry. But will our life be very, very simple? Like if we pass only this one entry, definitely it will become very simple, right? But we need to complicate. Or rather we can say, in the best interest of the public, the SEBI has introduced what I just told you. The face value will get divided into installments. So this simple entry will now be broken into entries. I told you the first is always the application, the second is always the allotment, and next we have the call money. So I will here itself take first call and the final call. So then it will be very easy for us to understand later. Now you will ask me, madam, when I collect the application money, so when the company collects the money in installments, what are the entries I have to pass? This one entry will get divided into two entries. So what are the two entries? I can say receipt entry for easy remembrance. Please take it as receipt entry. Receipt entry means the entry in which the bank is involved. Okay, receipt entry. And then I will have something called as the transfer entry. That means one which goes to the capital or the share capital. Clear? Now let me show you what are the entries to be passed. So I told you, ultimately, if you combine all the entries, you will get this value only. So 100 rupees instead of coming at one go, it comes within few installments. So first time, what will be the process of application or how will you apply for the shares of a company? You need to understand. If you understand that, then the passing of the entries becomes very easy for you. So the first thing that you people have to understand is a company by the issue of prospectus, it invites public or the people like us, you and me, to subscribe or to invest in the shares of a company. Correct? So after that, what happens when it asks to invest in the shares of a company? You will, through the prospectus, you will come to know, oh, there is a company and it wants to get money from us. Okay, how the company is performing, everything. If I invest money, will I get return? Something. You will do all your analysis. And finally, you want to buy the shares. How are you going to buy the shares? Is whatever is the application money you are going to see, and you will also fix this much is the amount I can invest. So I am going to purchase these shares. So first is the point wherein the public will directly send the money, application money. What money? Application money into the bank account of the company. So till the time the company receives this application, it does not know who are its shareholders also. Based on the advertisement, only when the shareholders are investing into the company by paying the first installment application money, the company receives it in the bank account. The company receives the application of the particular shareholders. Then it will sit there, it will go through. Okay, this person has applied for so much and this is his bank account. This much amount has come, everything. So the second step after receiving the application money, the company will come to an assessment. It will write down whoever has given and it will see how many shares are there, how much people have subscribed. Then it will make the allotment. It will say, okay, whatever money I needed, it has come. Now let us make them a part of my company. Those people who have given the application money, you have been allotted the shares. The moment allotment is done, you will get the allotment letter stating that you have become a part officially of the company or become the shareholders. Karke, you will be getting a letter. Okay, good. Now after that, the second one, when the allotment is being called, no, you know that these people are already your shareholders. In application, you don't know who are your shareholders. But from the allotment installment, whenever the company is asking for money, it will technically write to Mr. A, please give me so much money. To Mr. B, it will ask now. So it has got the confidence that these people are my shareholders at any cost they will pay. And now it will just send the call letters asking, please pay so much of money. Okay. So that is how in the allotment stage, the company comes to know about the shareholders. So similar way calls also will be made. Okay. Now the first thing when I talk about applications, still the shareholders are not known. So first based on the amount deposited by the shareholders or the people, the company will identify them. So the first entry for the application will be the receipt entry. Receipt entry means it will involve the bank. I told you. When you receive money, bank accounts get debited. But here, will you write the word share capital? No, I am not receiving the entire money. I am only receiving the application money. So it will be called as equity share application account. I am receiving money, but out of which installment? Application installment. So I will be writing it like this. So you will write money received on application. My dear students, since we are passing only the journal entries in this particular chapter and we prepare an extract of the balance sheet if it is asked, you are supposed to follow the formatting, the presentation of passing a journal entry. If you simply pass without any heading, without any proper thing, you will not get marks like what I'm passing here. You need to follow the format. Since I'm teaching you now, it is okay. When we start doing the problems, the format will be followed. In the books of so and so, journal entries, and then you pass the journal entries. Okay? Narrations are very important. I know few people asked me in the revision class, whether should we do so much of narrations? Write it in simple sentences like 2-3 words, it is sufficient. So once after I get my particular bank or the amount into the bank, the next thing that I have to do is quite simple. Transfer the money, whatever I have told here. Suppose I say 20, 30, 20, 30. So the entire comes to 100. So this and this is matching. Okay. Now 20 rupees I am receiving an application. 20, 20. Now the transfer entry is important because ultimately This 20 is a part of my 100. So it has to go where? To the share capital. So my share capital balance increases when I am issuing the shares. So since it is a liability, I have to credit the share capital. What will you debit ultimately? I have received money from application. I am transferring the application money 20 rupees to my equity share capital. That I am doing. So it comes to 20. Clear? So this is the transfer entry. Transfer to the share capital. This is the first two entries. Clear? Do you understand the sequence? Only in the case of application, first the receipt entry will come, then the transfer entry. Why? Because you don't even know who are the people who are applying for your shares. Okay, only after you receive the money and after you have allotted the shares, they become the shareholders of the company, right? Yes, so coming back to this. Now, madam, they have become my official shareholders. I have allotted the shares to them also. Now, what will I do? What is the thing that I have to do? You know that these people are already your shareholders. So, first, in the case of allotment, you will pass the transfer entry first on the belief that anyway these people are going to pay. Where will they go? So let me pass the transfer entry first. Even before receiving the money, I will pass the transfer entry. What is the transfer entry? Here what you have passed? Equity share application to equity share capital. Same way here it will be equity share allotment account debit to equity share capital. Will be equity share capital account. So the amount will be 30 and 30. So here again transfer to the share capital is the narration. Okay. And then after you transfer it to the share capital only, you write letters to them and ask them, please give me money now. So when they give you money, it will be the receipt entry. So what will be the receipt entry? It will be nothing but bank account debit. Because bank comes in through which part? It is through the allotment part. So it will be equity share allotment, which is 30 and 30. Equity share allotment 30 and 30. Now come to the next one. Okay. First call, final call, everything same. So how did you pass for the allotment? The same way. First you will have the transfer entry which says equity share first call account. It is 20 to equity share capital. So first I am going to transfer the money because I know these people will pay. So what is the point? I will start transferring and then I will get the receipt entry. So it will be bank account. Receipt will always have bank on the debit side. Bank account debit to equity share capital, which is 20 and 20. This is the point. And finally, for final call also, the same set of entries will come. That is nothing but equity share capital final call, equity share capital final call account debit to equity share capital, bank account to equity share final call. That's all. So this is how you are broken this particular single entry into two different kinds, and minimum 4 installments will be there. So 4 into 2, you will have 8 entries in total. Sometimes you can have lesser than that. Sometimes you can have more than that. Clear, everybody? Now, in the each entry, if you're trying to combine this entry, what will happen? The equity share capital is on the credit side. Equity share capital on the debit side. This and this will be going on. You will get bank to equity share capital, which is this entry. Now, come to this particular point. When you take off this and this, again, it will be bank account debit to equity share capital. Again, come to this entry. When you eliminate the share first call, which is on the debit side, credit side, you will get bank account debit to equity share capital. In everything, you are getting the same entry, but in different installments. That is the only thing. Clear, everybody? For application alone, first receipt entry will be there. Receipt entry means the one which involves the bank. And then your transfer entry will come. Ultimately, I received the money out of this particular installment. But where will it go? Where will it belong to? It will go to my share capital. Only in application, first receipt entry, then transfer entry will come. In all the other cases from allotment, first call, final call, what will happen? First the transfer entry will come because you already believe your shareholders. You know that these people will pay. First let me transfer, then let me ask for money is what you are going to follow. Okay. So now we are going to talk about the next. This is the basic accounting part. The next thing is I am going to talk about issued capital and subscribed capital. Very, very simple. What is it? Issued capital and subscribed capital. From here, our questions start. Okay. So, issued capital and subscribed capital. So, already I have explained what is this. Issued capital is that portion of the shares which the company is issuing to the public. So, let us say 10,000 shares the company has issued. Okay. Case number 1. People have taken up the entire 10,000 shares. That means the issued capital is equal to the subscribed capital. This will be called as the normal subscription. So, in a question where you find that whatever the company has issued, if the people have taken it up, then it is a normal subscription question. Let us come to the second question. I have issued 10,000 shares, the company, but the people, they don't only 9,000 shares. So what is this? Less number of shares have been taken up by the company. So this is called as under subscription. What is this called as? Under subscription. So what do I do, madam, in the case of this particular case wherein the number of shares subscribed by the public is lesser than the issued? Shall I not go ahead with the thing? Here again, SEBI comes into picture. The SEBI says when the money requested by the company, the entire money is not got, you should check the criteria of something called as minimum subscription. You should check the criteria called as minimum subscription. What is this? Whatever is issued, at least 90% of it should be subscribed. If 90% is subscribed, then okay, go ahead. But if 90% not subscribed, don't go ahead. You are supposed to return back the money to all the applicants. So here in this case, I have considered 10,000 into 90%, 9,000 shares have come. But if in the question, if there is only 8,000 shares given to you, you people have to write a note stating that there is an under subscription in the question and the SEBI regulation or the rule of 90% is not being met. Hence, it cannot be proceeded. The amount should be returned by the company to all the applicants. Like this, you should give a note. But don't worry, in most of our, it can come in MCQ. Okay? Most of our questions are there with a under subscription, and here what will happen? It will be 90% will be there. Clear, everybody? So in this case, my dear students, you can get a doubt. Madam, if I am having an under subscription, then what will I take? Number of shares which I should take, madam? This you will tell. So coming back, you have to always take the subscribed. If it is normal subscription, no problem. Even you take issued or subscribed, it is the same value. But in the case of a minimum subscription or under subscription or over subscription, you should always consider the shares that has been subscribed first. Okay? So here, under subscription, whatever shares you are having with 9,000, you should do the problem. So this is all we are talking about subscription. Now we come to the third type of subscription, very, very important. 10,000 shares the company has issued. I have received 15,000 shares. So this will be called as a case of oversubscription. The company has a very, very good image in the market and everybody want to get the shares from the company. They have just oversubscribed to it like crazy. So I need only 10,000, but I have received almost 15,000. So where my subscribed is more, that is called as oversubscription question. Now what will I do with this oversubscription, madam? How should I deal with the oversubscription? What should I do? So the remaining, how much is there? Excess. So always the company will be having 3 things to be done. The company will have 3 options to be done. What is that? The first option is reject it fully. What is that? The first option is reject it fully. The second option is no, I will accept it. What is the meaning of accept? I will tell you a little later what is the meaning of accept, okay? Or this is also called as pro rata allotment. I will do a pro rata allotment, or I can take a combination of both. That is 2,500 shares I can accept, do pro rata allotment. 2,500 shares I can do a reject. Okay. So I can accept also, I can reject also. I can do that combination also. Is this clear to everybody? So now we are talking about the subscription part. Clear? We are talking about the subscription part. And now let us go and see a particular question in the textbook, right? Wherein we will be right. So here they have mentioned the journal entries for the issue of shares in cash. That is what I was talking about. First, the bank account to the share application. First one will always be your receipt entry. Okay, because in the application, you still don't know who are the shareholders. So you will do the receipt entry first, bank account to share application. And on the allotment, what will you do is you will be passing, this is for the pro rata journal entries. Okay, fine. So coming back, they have also shown like this receipt of allotment money, it will be here. What is the thing here? They have passed both transfer entries together. But what we are doing usually, we pass first the transfer entry for one lot, that is application separately and allotment separately. Since they are, what they felt was like, anyways, it is coming the next. Now let us combine and do it. Like this also you can do it, no problem. Okay, so sometimes there cannot be a separate share application allotment accounts are not prepared separately. In that case, the name will become to share and allotment. Okay, to share application and allotment will be the name. So there is nothing that is being done. And then, okay, on the call being made, share call account to share capital. First, the transfer entry. When you receive money, it will be bank account to share capital. Okay. Now, all of you, please see this particular question, illustration number 2. The illustration number 2 says a company has invited applications for 10,000 equity shares at rupees 50 each, payable on application 15, on allotment 20, on first and final call 15. Applications are received for how much? 10,000 shares. So show journal entries in the books of the companies. So 10,000 shares, 50, 15, 20, 15. First thing, whenever, my dear students, you are getting a question of the shares, I will show you how to write the format. So the format or the thing that you write before entering or going into the journal entries is very, very important. So the question that we have seen now, it talks about, we are in illustration number 2. It is a normal subscription question. What it is? It is a normal subscription question, which says very, very clearly that 10,000 shares are issued at the rate of 50. Always make it like this. And then it is divided into 15, 20, 15. 15 on application, 20 on allotment, and this is on the call. Whenever the bifurcation is given, write it like this and then take the value. This should always match with this. Okay? Since it is a normal subscription, whatever the company has issued, it has got. So 10,000 it has issued, 10,000 it has got already. So now the entries will be, you should pass two entries in each of the case. Correct? What are the entries that we are going to pass quickly? First one will be, you can all start working out with me, bank account to equity share application. Okay, bank account to equity share application, which is nothing but 10,000 shares into, you should not consider 50, no, application will be considered. So 10,000 into 15 will be 1,50,000 rupees, 1,50,000 rupees. So what is the narration that you will be writing? Money received on application. Don't use short forms like I am doing. You people have to use the full forms. Fine. And then we have equity. Next is the transfer entry. Very easy. Equity share application account debit to equity share capital. Right? Equity share capital account. Again the same 1,50,000 and 1,50,000. So here is the transfer entry made. And the next one comes to your allotment. In allotment, the first entry will be the transfer entry. So it will be equity share allotment debit to equity share capital. Okay. So this comes to how much now? 20 rupees into 10,000. So it will be 2 lakhs and 2 lakhs. Please write the narration. The next entry will be the receipt entry, which is nothing but bank account debit to equity share allotment. That is what you're doing, share allotment, 2 lakhs and 2 lakhs. And the final call is 15 rupees into 10,000. So what I will do, the first transfer entry I will be making. Share final call account debit to share capital. That's the first entry. 1,50,000, 1,50,000. And finally will be the receipt entry. The same thing, bank account debtor to share final call. 1.5 and 1. Clear? So this is how you will be doing. Please write the narrations. Narrations very, very important. And also you should write in the books of so and so company, the journal entries. You know the format for journal entries. First will be date, then will be particulars, and then will be the ledger folio, debit amount, credit amount. The 4 columns should be there. Since there are no dates that is given to me here, I am not using it. Let us go ahead with the next question. Quite simple problems. Okay. The next question. Please see the question number 3. Illustration 3. On 1st of April 2021, A Limited issued 43,000 shares of 100 rupees each, payable as follows. So what I told you to do, payable as follows means we need to change this particular the ring here. Whenever you are getting a question, so you need to first write how many number of shares. I will again make it normal, okay? Don't have to worry. So see here. So 43,000 shares of rupees 100 each payable has 20 on application, 30, 25 and 25. Okay. By 20th of May, 40,000 shares were applied for and all the applications were accepted. Allotment was made on 1st of June. All the sums due were on allotment were received on 15th July. Those on the first call on 20th and first call 20th of October, they have received it. Okay. Now, see the question here. How much shares the company has issued? It has issued 43,000 shares. Okay. It has issued 43,000 shares. But how many shares have been applied for? How much people have subscribed for? They have subscribed only 40,000 shares. Now, the question is, what am I supposed to do? So, this is a question of under subscription. My dear students, in an under subscription problem, what should you do first? You should check whether that shares received are coming to 90% of the total issued shares. For example, in the question, we have 43,000 into 90% comes to 38,700 shares. But actually, how much you have received? You have received 40,000, so it is more. So now what you have to do? The condition is satisfied as per SEBI. I will continue with my question. Now the question here is whether should you take 43,000 or should you take 38,700 or should you take 40,000? My dear students, how much they have applied, that only you can consider. So the question now becomes like this. The question becomes 40,000 shares issued by A Limited at how much? 100. In that we have the classification given to us as 20, 30, 25 and 25. So total comes to 100. Yes, this and this is matching. Everything is okay. So you will pass the same entries, but the only change is the 40,000 shares will be considered. So in this entry, it will be 40,000 shares into 220. So it will become 8 lakhs. So first will be the receipt entry. And next will be the transfer entry. That also will be 8 lakhs. Clear? Please write the dates when the application is being made that they have given to you. Dates have to be mentioned. And the second one is for allotment. In allotment, 30 into 40,000, it becomes 12 lakhs. Clear? 30 into 40, it becomes 12 lakhs. Then 40,000 into 25 is for the first call. So it becomes 10 lakhs. Here 10 lakhs and here also 10 lakhs. Here everybody, 10 lakhs and 10 lakhs. And the final call again will be, there will be two more entries that's coming into picture. I will write it here. It will be share final call account debit to equity share capital. How much it is? Again 10 lakhs and 10 lakhs. It will come to 10 lakhs and 10 lakhs. And then we have the receipt entry. Write the narrations and write the dates also. To the share final call. 10 lakhs and 10 lakhs will be there for. Right? So this is your illustration 3, which talks about an under subscription. So how will you deal with it? Simple. Check for the 90% criteria. So out of 43,000 shares, the 90% comes to 38,700. So you have received more than that. So 90% more than that you have crossed. So go start, do your question with whatever you have received. How much people have applied for, with that you have to start doing the question. Now let us go ahead and see one question. The next question wherein if you have an oversubscription, what am I supposed to do? Okay, oversubscription, what am I supposed to do? Now come to the next point. Oversubscription. Okay, please see here. Panth Limited invited applications for 50,000 equity shares at 50 rupees each, which are payable as 20% on application on allotment and first and final call 20, 20, 10, 20. The company received applications for 60,000 shares. So it is oversubscription. You have issued 50,000, but you have received how much? 60,000. So how many more applications? 10,000 more applications. So what should I do with the excess will be the question. What has happened? Please read here. The director accepted application for 50,000 and rejected the rest. Show the journal entries if the company refunded the application money to the rejected applicants and the allotment money was received for only 45,000 shares. So there are two things that is actually given to you here. What am I supposed to do? So the thing here is very simple. My dear students, again you need to make the table, okay? You need to make the table. There is no change in making the table. Same table should be made. So in the illustration 4, what happens? Company has issued 50,000 shares, but you have received subscription for how much? 60,000 shares. So what did they decide to do? I told you 3 things they can do. First thing is reject it fully. Second thing is accept it fully. That is the extra accepted, or do partial reject, partial acceptance. This is a simple question. Completely they have rejected. So the excess 10,000 is rejected. How will my accounting entries get affected? Okay. How will the accounting entries get affected? So this is 50 rupees. It is divided as, just a minute, 50 rupees divided as 20, 10, 20. 20, 10, 20. Okay, so this is 50. Now, my dear students, please listen very, very carefully. Whenever you have an oversubscription problem, the first entry will be done differently. The second entry, which is, what is the first entry? The first entry is nothing but your receipt entry for application. The meaning is how much money the people are investing in the application, that will come here. Now, you people tell me what is the amount that I have to write here. Anybody? So it will be simple. How many shares they have subscribed? People are subscribing. Application mein people are first giving you money. How many shares they have subscribed? 60,000 shares they have subscribed. Correct? From here only you should be really, really careful to understand the concept and see in which of the entry what amount I have to take. What shares I should multiply. Whenever there is an oversubscription problem, the first entry will always take the high number of shares. That is whatever they have subscribed. So here the people have subscribed for 60,000. So they would have paid 60,000 into 12. That is nothing but 12 lakh rupees they would have paid. Correct? So it is nothing but bank account debit to equity share application 12 lakhs I received. My dear students, whenever there is an oversubscription problem given to you in the question, when you read it, always remember in application, the first entry, you will take only the number of shares the public has subscribed and multiply it with the application money. This is the first entry. Second entry is what? Transfer entry, correct? This transfer entry, there is a change that you have to do. Whenever you find there is an oversubscription question, immediately you please make it very, very thorough inside that. The second entry, which is the transfer entry, will become a CBA entry. What is the CBA entry? Very simple. In the credit side, share application account debit, this will remain the same. In the credit side, you are adding two more accounts. Very simple. Two bank account to equity share allotment account that you are going to add. Why I should add, madam? Because when there is an oversubscription in the question, I told you the company can either reject or it can accept in full or it can do a part. It can partly accept and partly reject also it can do. Correct? So whenever you see there is an oversubscription, even without reading, the second entry converted it into a CBA entry. Why are you calling this a CBA entry or how are you calling this is nothing but C, B and A. Allotment A, the CBA entry. So what is the meaning? How are we going to write the amounts first? The application amount will be flowing from this 12 lakhs. It will come here. Okay. Equity share application will come here. Now starts the real question. Now starts the real question and the real concept understanding. Come here. Now equity share application shows you 12 lakhs because 60,000 people have subscribed and they have paid this 20 rupees. Okay, that is okay. But share capital will always show the actual number of shares issued, face value. So what is the company wants? Here, what is the company has issued? Actually what? Issued only 50,000. So equity share capital will be the number of shares originally issued by the company irrespective of whether it is an oversubscription problem, okay? 50,000 into what is this face value? It is 20. So here it will show as 10 lakh rupees. Once again, I am telling you, when it is a oversubscription problem, then this issue will come. Now you can ask me, what about normal and under subscription? Normal, no change. Whatever is issued, same thing is subscribed and received. Over. In under subscription, I cannot take this higher value because why? Already they are giving me only lesser shares. So I don't even have the remaining money with me. Correct? But in the case of oversubscription alone, this thing you should be careful because even though the people have given a higher amount for you, in the share capital, to the share capital account, how much you have issued into the particular face value will always sit inside this. Okay. So make yourself very, 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 very thorough. It is always face value, number of issued shares. Always face value, number of issued shares. Okay. This is over. Now, okay. Now, what is happening to this 10,000? They are rejected. So the money is coming. Money is now given back to them. When you are refunding, your bank gets decreased. With how much? How many number of shares are rejected? 10,000 shares into what is the application money they have paid? 2 lakh shares. And now is anything adjusted here? No, you don't have information. So put a dash. Then I need not even write now, madam. Why should I put something and then put a dash? You should do this because the moment you see an oversubscription in the question, you should get a practice that the CBA entry will be the second one. So the receipt entry will be with 60,000, you will pass the entry, how much total money you are receiving, subscribed shares into the amount. And here into this particular equity shares, the second, the transfer entry becomes a CBA entry. It becomes a CBA entry, which means that the excess can be either rejected, then it will go to bank. The excess can either be accepted. That means I will take it to my share allotment account. Anything can happen. Okay. In this illustration number 4, it is just the returns that we have seen. Okay. Everything is entirely rejected. And then we have a particular question. And then we have This application is done. Next, you come to the allotment. What is the entry that you are going to pass for allotment, my dear students? The first one is the transfer entry, correct? The transfer entry says equity share allotment account debit to share capital. Okay? Equity share allotment account debit to equity share capital account. Now you will get a 60,000, 50,000. 60,000 is gone away from the question, over. 60,000 comes only in this entry. From the second entry, when you are adjusting the value here, the amount or the number of shares will be only the original shares, which is 50,000. So now it will be 50,000 into what is the allotment money that you want? 10. So it will be 5 lakhs, right? It will be 5 lakhs. In the question, there is something called as one particular shareholder or the company, okay, and the allotment money was received only for 45,000 shares. That means what? Again, some subscriptions happen? No. Once after the shares have been allotted, I told you, there can be sometimes the shares not paid by the shareholders. So in this case, how many shares are not paid? 50,000 actual, 45,000 only they have paid. That means there is a calls in arrears. Whenever there is a calls in arrears, please put it in the bracket like this, opposite or with wherever you have that particular call. So here it is in allotment, 5,000 shares have been defaulted. So I am writing it straight to the allotment. If it happens in first call, please write here. If it happens in the second call, please write it there. Okay. But when you are forming the question and the entire thing, you are supposed to write it then and there. Then what is the effect, madam? Please always, please, all of you, please see. Under the receipt entry, bank account debit, then you have calls in arrears account debit to equity share allotment. This will be the entry. Why are you taking calls in arrears on the debit side, madam? Because calls in arrears is a loss for the company. Because it is a loss for the company and it has to be shown on the debit side. Can we write the amounts, everybody? So now the amount here, share allotment will be 5 lakhs. It is coming from this entry. Now, how many shares have not paid, ma? 5,000 shares are not paid. 5,000 into 10 comes to 50,000. And here the amount received is 4,50,000. Clear? The amount received is 4,50,000. So with this, we have finished the illustration number 4 also. I would like you people to try the illustration number 5 the same way. Okay. So I will just show you. I'll just share the screen before ending the class. I think it's already time. I'll just take few of your doubts now. So here the next question of the illustration 5. Here it talks about both equity shares and preference shares. What is the difference? Same entries will come. But the words, instead of equity share capital, you will use the word preference share capital. Everything else is the same. Okay. So here, 50,000 equity shares, 100 each, and 1 lakh preference shares of rupees, 100 each. Okay. And then you have this particular thing. Everything was subscribed. Final call was received. That means in equity shares, out of 50,000 shares, the final call is there. No. For this 25 rupees, what has happened? I received only 42,000 shares, which means that the remaining 8,000 shares is calls in arrears. So which entry it will affect? It will affect the receipt entry, bank entry may you have to debit the calls in arrears account, which is 8,000 into the value of this 25. Clear, everybody? The same way for preference shares, only 88,000 is being received. So 88,000 out of 1 lakh preference shares, I have only 88,000 given to me or 88,000 have paid, which means that the remaining 12,000 is calls in arrears. So 12,000, again, this also final call, 30 rupees. 12,000 into 30 will give you the amount. Please write it under calls in arrears and close that particular thing. Here they have prepared the cash book. Cash book is quite easy based on first pass the entries. Wherever you have a debit, please debit it. And then here all will be debit because you are receiving money. Okay, there is no oversubscription also. Right? And then shares issued at a, okay, this is the next concept which we'll be seeing in the next class. So the next class we are, So the next class we'll be going ahead with unit 2. I'll be finishing off unit 2, and based on the time permits, I'll be starting the unit 3 also. Clear? So now let me take the final, like the doubts you people have been raising hands, right? So let me first check it out and take. Anybody? Okay. I'm now unmuting you people so you can ask me. Thank you, Kumar. Bhargav, are you there? Can you just unmute? Yeah, no problem. But can you unmute the people who have actually raised the hands, please? I'll take the doubts. Yeah. And you can also actually come on your thing. Okay, there is your viewers portal also where you can actually raise queries for people who are not able to access your Zoom, right? So there, people who are watching on YouTube also, you people can do that. Issue value and the face value. Okay, Shoaib Ali has given a thing. Can you explain? Yeah. Yeah, can you explain the difference between issue value and face value? I already told you face value is the value that is written on the face of the share. But issue price can be more than that. So that is the concept that we are going to see in the next session, where you are issuing shares for a price more than your face value. It is called as premium. So in all cases, sometimes you can have issue value is equal to face value. 10 rupees share can be issued at 10 rupees. 10 rupees share can be issued at 15 rupees also. This is increase. So this is at the increase is issued at premium. Few times 10 rupees can be issued at 8 rupees or 9 rupees. This is a discount, but technically you cannot issue it at discount. The concept I will teach you later. Okay. Yeah, Shoaib, I think I have taken. Bhargav, is anybody there? Like for the things, I think there few people raised their hands. Can you see? Indu Kumari and Gauri.
Ma'am, illustration number 5. I can't understand cash book.
Okay, illustration number 5, you can't understand the cash book. What is your main doubt in the cash book? Have you first passed the entries?
Yeah, ma'am.
Okay. When you pass the entries, here bank is coming. Cash book is nothing, but it also deals with the bank entries, right? So what is happening to the bank account in your particular question that you have done? Which side is the bank coming in the entries? Probably if you see here itself, you will understand. The bank entries are coming on the debit side. That is, when you are receiving money on account of application, bank is getting debited. Then here also, when you are receiving money, if this you leave, here also when you are receiving money, bank is getting debited. So technically, whenever I am issuing shares for cash, I am receiving money, right? So in all the installments, in application entry also, in the allotment entry also, first call entry also, final call entry also, I am receiving the money. So whenever the money is received, you are supposed to debit it. Okay, and take it to your cash book on the debit side. That is why in the illustration 5, if you watch thoroughly, illustration 5 has two things: equity shares also, preference shares also. For each one of the items or the entries that you're passing, all the banks have to be taken to your debit side of the account. And after you take to the debit side, is there anything refund? Do you have any refund in the entry? Because it is a normal question, you don't have any refund that is being coming to you. So that is why all the debits are added and finally taken as the balance carried on. Closing balance comes on the credit side.
If it is refunded, then cash book.
In cash book, credit side it will come. Simple, no? When you receive money, you will debit it. When you are refunding it, you will credit it. Okay?
Okay. Thank you, ma'am.
No problem. The others?
Good afternoon, ma'am.
Good afternoon.
Am I audible?
Yes, please.
Ma'am, I have a question that as per Companies Act 2013, then that it must be at least 5% should be received on application.
Correct.
Is it?
5% of the face value should be received on application. But what happens here, no? A company which is supposed to follow two rules, okay? Whenever you see, there are two rules that is applicable. One as per the Companies Act, The other as per the SEBI rules, okay? In the interest of the public, it is better to have more money. So that is why when I was teaching you, I explicitly told you 25% of the issue price, which means that the application money will be at a higher value. Definitely the company will not want to ask just 5%, no. So if in your MCQ question, is this particular question is going to come, it says that companies act 5% of the issue of the face value to be maintained at least, means that is also correct. And here 25%, not less than 25% of the issue price is also correct. Okay. But out of the two, what I am trying to tell you is, for the best interest of the public and in the interest of the company, it is better to have the higher value. So obviously 25% is the higher value, no? So the business will be getting a higher amount on account of application. Right? You're there? Yes, please. Thank you, everybody. Let's, meet on the day after.